What you've seen is that the move in gold price has really occurred with very little retail participation. If you look at the statistics around physical gold ETFs, until about 5 weeks ago, retail investors in the Western world, at least, were dishoarding or selling gold. The strength in gold has been central bank buying. Now, I would agree with your statement that gold traditionally does well in the context of inflation. But what's kicked this gold bull market off, really, I think, is the weaponization of the US dollar. If, as I believe likely, that the follow through is retail participation on top of continued central bank buying, then I think, Jimmy, you see a real move in the gold price, and that's what I'm anticipating will occur.
Gold has emerged as a standout performer in 2024, driven by the significant gold purchases by central banks and the increasingly challenging macroeconomic conditions. The data from the World Gold Council reveals a staggering trend. Central banks have acquired more gold in the past 2 years than in the previous 50 years combined. In 2022, global reserve banks procured 1,136 tons of gold, the highest since 1967 and the second highest since 1950, marking a 150% surge from 2021. The World Gold Council further reports that the apex banks added another 1,037.4 metric tons to their reserves last year, the second highest annual purchase in history. Even with the high standards set over the past couple of years, the intense gold buying spree has rolled into 2024, spurred by the latest surge in gold prices. Global official gold reserves jumped by a net 290 tons in the first quarter, setting a new record in the WGC's data that dates back to 2000. This figure is 1% higher than the previous Q1 record of 286 tons set in 2023, and a whopping 69% above the 5-year quarterly average of 171 tons. Rick Rule, a highly renowned and seasoned investor, speculator, and founder of Sprott Global Resource Investments, says things are about to get even more exciting in the precious metals and resource sector, as retail investors are now showing renewed interest in gold and silver. Rick explains that retail investors, who have so far shown a lot of apathy toward gold and silver investments, are realizing that the global debt-based fiat is doomed and a collapse is inevitable. Though the awakening is happening at a slower pace than Rick wants, he is certain that things will pick up rapidly in the coming years, which will be great for tangible assets like gold and silver. In a recent interview with Jimmy Connor, the legendary investor discusses central bank gold accumulation, noting that the apex banks, particularly those in emerging markets, are buying gold to challenge the West's dominance and prepare for a new world order. In this new order, the global economy will be backed by tangible assets like gold and silver, which have protected investors for thousands of years, instead of easily inflated fiat currencies like the US dollar. Rick uses the example of the US economy because, despite being a global superpower and the issuer of the world's reserve asset, it is heavily indebted and on the verge of a nasty collapse. We will now present clips from Rick's interview. Please watch, share, and like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. Thanks for the support, and enjoy the video.
I think it comes to two general things. First is the weaponization of the US dollar. The US government has decided, in their wisdom, by the way, whether or not you agree with US policy, to export US policy to other countries who may have their own agendas. The weaponization of the SWIFT banking system, which is not US property, but the US government has decided to do anyway as a consequence of the fact that it's denominated in US dollars. And further, the theft by the US government of $300 billion worth of Russian holdings of US treasuries. Again, whether or not you agree with Russia's policy or America's reasons to do so, has caused governments around the world who believe that they might come into the sights of the US government. As an example, the Russians, the Chinese, the Indians, the Saudis, to question their holdings of US Treasury securities and their use of the US dollar for international trade. A second problem, I think, is that the arithmetic around US Treasuries has gotten worse and worse and worse. We came through a period really of US dollar hegemony. I would suggest in the period 1982 to 2022, the internationalization of the US dollar and the decline in both nominal and real interest rates were tailwinds for gold. now I think that foreign countries in particular that look at the US dollar and look at US treasuries see an instrument which pays them 4.3, 4.5%. I'm talking about the US 10-year in a currency where, separate and apart from the CPI, they see the purchasing power of the currency decline by 7 or 8% compounded. And so they're stuck with this sort of a conundrum. You invest in an instrument which gives you a negative real rate of return, and you do so while exposing yourself to the risk of the extraterritoriality of US policy. It's a real lousy bargain for those countries. It can't be any surprise that the Chinese, as an example, have reduced their holdings of US treasuries by about 70%, pardon me, over the last 5 or 6 years. In the first instance, they think that investing in their own economy and in their Belt and Road strategy around the world yields higher real rates of return than they would if they were invested in US Treasury securities. And they also allow themselves to escape, at least in some sense, the extraterritorial imposition of US policy through the US dollar. So it's no particular mystery as to why foreign holdings of gold have increased and foreign holdings of US treasuries have decreased.
Well, that's what central banks are doing now. You made mention of the fact that investors, both institutional and retail investors, are not participating in the purchase of gold or gold equities. Why?
Not to the, well, in the last 5 weeks, my evidence comes from the ETF holdings. They have begun to participate. Why they didn't participate before is a matter of conjecture. My conjecture would be that gold is an instrument that reacts to fear. And we've lived through 40 pretty benign years, going back to the beginning of the lowering of the US interest rate in 1992, all the way through 2022. Stock market was up, the bond market was up, there was lots of liquidity. I'm not trying to say there weren't some punctuations, 1987, 2008. We had some pretty dramatic punctuations, but the lessons that we learned as investors in those punctuations were that you'd buy the dips. The truth is that people were pretty optimistic because financial markets were continuing to do well. This reminds me a bit, frankly, of the late 60s and early 70s, when all of the indications of inflation were in the system, but people hadn't experienced it yet. They'd lived through 2 benign decades after the end of World War II. And while people read about inflation, it wasn't till they had sort of 5 years of experience with inflation. It wasn't until they'd seen the price of gas at the pump go from 20 cents a gallon to $1 a gallon, as an example, that they began to internalize the lessons. And I believe that the same process is underway right now.
According to Rick and several other financial analysts and commentators, decision makers and the general US populace are suffering from recency bias, the tendency to overemphasize the importance of recent experience or the latest information in estimating future events. This cognitive bias makes people believe that recent situations and events are more likely to continue instead of a disruption similar to historic events. Experts believe that's why many Americans will be easily misled that all is well with the economy until it's much too late to save themselves. But the actual truth is that all strong economies eventually collapse, and all superpowers lose their reign to other superpowers. In the modern era alone, several dynasties and empires, from the Spanish to the British, have gained and lost power. So it would be extremely arrogant to believe the US can rule forever. Let's return to Rick's interview, in which he discusses the state of the US economy and what's coming.
My belief is that after 3 years or 4 years or 5 years, people will begin to understand the price that they pay for the diminishment of the purchasing power of the dollars that they earn working or in their savings. I suspect that you'll look at the CPI, which suggests that, quote, inflation is moderate at 2.6%. But you'll look at what happens to the basket of goods and services that you purchase that impacts your lifestyle. And you'll say, wait a minute. The purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. And if you experience that over 5 years, if you watch your rent, as an example, if you were a renter, increase by 6 or 7% compounded. If you watch the cost of a shopping basket full of groceries increase by 100% over 4 years, all of a sudden you come to the same conclusion that retail investors came to in 1972 and 1973, which is to say, all is not well. And I think it's that consciousness that really kicks off a market in the metal. And let's talk about one other thing while we're at it, which is to say the probability of increases in the future. I don't want to give you a Canadian number because I don't know it. But in the US, the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, though, Medicare, Medicaid, Social Security Trust Fund, military pensions, government pensions, all that kind of stuff, exceed, according to the Congressional Budget Office, $100 trillion. And we propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Now, how do we get ourselves out of this conundrum? Understanding that America's GDP is under $30 trillion, which is to say our GDP is less than our on-balance sheet liabilities and is 20% of a combination of our on-balance sheet and off-balance sheet liabilities. How do we solve this? Well, they say, tax the rich. Top 1% of Americans have an aggregate net worth of $5.8 trillion. If you stole the entire net worth of the 1% in the United States, you wouldn't have solved the debt. What you would have done is funded, something like 20 months of the deficit. How about curtailing benefits? Let's say to the old guys like me, hey, Rick, you voted yourself a whole bunch of cool benefits for 40 years. You forgot to pay for them. We're not going to give you the money. You follow me? There's a whole bunch of hard choices. And you know what? We faced those hard choices before. Not as hard, but we faced them in the decade of the 70s. We had unsustainably high debts. We couldn't raise taxes. So what did we do? We inflated away the real value of the obligations. The purchasing power of the US dollar over the decade of the 70s declined by 80%. So we didn't renounce the debt in the honest, old-fashioned way by saying, yeah, we owe, but we ain't going to pay. Too bad, too sad. What we did is we made the debt less important relative to the inflated dollars that we took in via taxation. So my suspicion is that the way that we deal with this $130 trillion obligation or series of obligations is that we, in effect, inflate away most of the present value of the obligation.
According to Rick, there are 3 solutions open to the US economy. We continue printing excessively and debasing the dollar until an inevitable debt spiral, improve the government's revenue through increased taxation, or drastically cut spending. Unfortunately, it's been decided years ago that the only way forward is to borrow as much as required, even if the dollar loses all value. This is why Rick and others advocate owning gold and silver to store and preserve your wealth. What are your thoughts on Rick Rule's interview and his analysis of the current economic situation and market conditions? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.